Welcome to KP Data Investing channel. Our focus is to find the best investment opportunities in stocks. Today we are not going to talk about individual stocks, but rather, we will discuss how to manage the losing stocks in your portfolio. In the past couple of weeks, we have seen the indexes dropped more than 15% from the all-time highs. If you have watched our previous videos, we accurately projected the strong support level of S&P 500 at 4200 level. S&P has since repeatedly tested that level for 3 times, and they held onto that trading range. Anyone who watched that video must have protected their portfolio in certain ways. After the third attempt that failed to break below our projected trading range, S&P has been making a higher high and higher low in the last couple of days. This indicates an uptrend is potentially occurring. All of a sudden, the negative sentiments we have seen on news or social media before are no longer sending the market to trend downwards, stop the downtrend momentum, which proves that we might have seen the bottom. It is only a might have seen kind of bottom because we only act on probabilities. If the market action turns, we as our portfolio manager needs to act correspondingly. Given the high probability that the market might have bottomed. In recent weeks, we have acted and have been buying several small-cap companies. Of course, that includes the 2 stocks, Medifist and Foot Locker, that we mentioned in previous videos. Before we tell how to manage the losing stocks in the portfolio, let us present 2 scenarios. And we want everyone to read the instructions carefully and answer it with absolute honesty. We will give 10 seconds for each scenario to let each one of you to think about the decision that you will make. It won't be difficult, just simply binary, this or that answer. If anyone who needs more time, just pause the video and get back on it. Okay, let's get started. We believe everyone must have played cards before. In scenario 1, you have 4 aces in front of you. Nobody knows which is which. And nobody knows the arrangement. But you have been given with 2 options. Option A is to not draw any of the cards, and you will be rewarded with $2,000 straight away. Option B is to draw one of the cards, and only the red ace of hearts will be rewarded with $4,000. If you picked other aces, such as the ace of diamonds, clubs, or spades, you don't get to have any money and you have to walk away empty-handed. Which will you choose? Option A or option B? We now have 10 seconds to decide. We believe most people will go with option A. Because at least we get to leave with something in hand. Just don't pick the cards, and we get to have $2,000. We don't want to take the risk of walking away with nothing. Then up next, here is scenario 2, which is pretty much the same with the first scenario. This time, you are also presented with 4 aces. You have been given with 2 options as well. Option A is to not draw any of the cards, and you will lose $2,000 straight away. Option B is to draw one of the cards, and only picking the red ace of hearts will get to not lose any of the money. But, if you picked other aces, you lose $4,000, all of your money is now gone. Which option will you choose this time? Option A or option B? We also have 10 seconds to think about it. In this scenario, we believe most people would rather choose option B. Because we get to have the chance to not lose anything. We would have the kind of hope that there might be the probability we can get to walk away without losing any of our money. If we choose option A, we would have lost $2,000 without giving a try. We believe most people would prefer trying their luck. And perhaps we get to leave without losing. If you answered scenario 1 with option A, and answered scenario 2 with option B, you have just got into one of the most commonly known mental traps, the prospect theory. The theory posits that losing hurts more than winning feels good, suggesting that you and most investors would rather double down than admit defeat and take the loss. We have the impulse to hold on to loser than accepting a loss or a failure. No one likes to admit when they are wrong. For investors, this can lead to the inclination of selling the winners too quickly and hold on to losers too long. This also trapped us in the concept of opportunity cost. We could have used the money from selling the losers to buy another company that will likely deliver similar or even way better future returns. We constantly need to decide whether we should take action or simply do nothing to our portfolio. Even the decision not to decide is still a decision. Each decision involves varying levels of risk and uncertainty. If any of you want to beat the market index performance when managing our portfolio, we need to be more objective in assessing all the stocks in our portfolio. Human psychology works against us, making us incredibly hard to determine when to cut your losses or hold onto investments. We sell when we should buy and buy when we should sell, and are overly influenced by the noise around us. The most common way to tackle this mental trap is objective assessment. We understand that this sounds easy in certain extent. But we have biases to our holding stocks because we don't want to violate or admit that we were wrong with our initial investment thesis. By selling at a loss, you are admitting that your judgment was wrong, and you are afraid to live with that. How to deal with this? First, we need to avoid anchoring bias, which means we don't make decisions concerning our purchase price. Nobody in the market cares about your purchase price. Nobody, except you. So, just ask yourself one simple question. Assuming you don't know anything about this company, never ever heard of it before, will you remain bullish and buy in this company at this current market price even after you have done your due diligence? You must answer this with absolute honesty. Even those are the speculative stocks that you only allocate a small percentage in your portfolio. You need to be truthful to yourself. If not, it only brings damages to your portfolio performance, nothing more. Money, stock market, or the stock price don't have the emotion like humans do. They are just numbers after all. Nobody cares about your purchase price or performance. Only you are responsible to your own decision. Don't let your ego to influence you and keeping you away from making the best and optimal decision to your hard-earned money. We put in the effort in making our money. We bet nobody would say that those are easy money. So why you think that it would be easier to make money through the stock market without doing your due diligence and challenging the mental traps that you are aware of after watching this video? We think you will become a better investor after today's video. Thank you for watching. Hope that the information is helpful and will bring insights in managing your portfolio. If you like our video, press subscribe and like button. Investing is not for everyone. Hope to see you in the next video.